Hey everybody. So as I've been saying lately, I felt that the bounce back is going to be very, very highly correlated, right? Because the sell-off was just a sell everything, baby out with the bathwater, just get out of everything. That's how liquidity events generally. I've been through a lot of bull and bear markets. Liquidity events get very, very ugly at first. They take no prisoners. And shoot first, ask questions later, throw in whatever sayings you want there. That is how it works. Now, the bounce back, I said everything's going to come back to a certain extent, but then they are going to start to parse through the market for this current environment that looks like more and more like it's going to be very, very difficult for the economy, difficult for sentiment, for confidence. All these things are happening, and the longer this goes on for, the worse it's going to get if we don't get a China deal of some kind. So there's certainly not much sort of that we got a little bit of a put last week, the bond put. We got some easing from Trump in a couple of other little small ways, but really the rhetoric is quite strong still. So the damage is being done day after day after day. And so as I said, this is how I think things are going to work out. And you can see over the last 5 days, we can see exactly what I was saying could happen, which is into utilities, staples, healthcare kind of unchanged, but look where they're getting out of. Discretionary, right? There's people buying stuff that they don't necessarily need. Discretionary items, that extra income, that extra money that you have to blow on things, not doing well. Communication services, IT, information technology, right? So this is technology right there. Energy bouncing back a little bit today, but still hasn't done very well. It's a bit unique, I think. Sometimes energy can be a bit of a reflexive sort of bounce into difficulty. Historically has done okay in times where that super high concentration comes down, but I'm not taking part in it just because I love some of those companies are fantastic, huge cash flows, great, massive moats, great companies, but I just feel like oil just is going to continue to go down given what's happening around the world, the Saudis, OPEC, et cetera, and growth. So I just don't, I'm not loving it right now. So, but this is exactly the picture of what we're thinking could very well happen if things just continue to kind of bifurcate, right? So here we go. We can see since the election, here's your SPLV, which is your low vol stocks. It's things like Walmart and Costco. Costco's not cheap, but it's J&J, it's Colgate-Palmolive, it's Waste Management. It's the stuff that the real things, right? We're sort of moving away from digital economy type stuff lately and into real touch feel things that people need, as opposed to these high growth multiple kind of stocks. And with overhead resistance, charts that look terrible. You look at some of those mags. I keep telling people, do not run into these stocks with gusto because the charts look terrible. Moving averages pointing straight down. I think you can hope for nice bounces into sort of 9 EMA averages, things like that. Maybe the 20 if we get a big bounce. But these charts are just not looking healthy, right? So they're moving into those safer things. SPY down 7.85% since the election, with this low vol area being up 2%. And that really is kind of something that could very well continue. We're going to get some knee-jerk reactions. There's always the risk that a very sudden surprise deal with China it gets us a massive rally. But I'm almost getting to the point where I feel there's significant damage being done. So very concerning market. I've been telling members, mentoring students in my program, that it really, you should be collaring left, right, and center all over the place. And I'm going to show you one trade that I did because I think it's just getting very concerning. Here, let me update this chart. Here's the S&P. Basically, we came back up into this area where I was kind of hoping for maybe 560, but that was a lot to hope for. We basically bounced up against this 20-day moving average. We were bouncing around between the 9 EMA and the 20 for a little while. Now we're breaking down. This is where I think there's quite a bit of concern to the downside. We are seeing a softening in the daily ranges that we've seen, but I don't think that's a surprise. We saw daily ranges higher than we did during COVID and some very, very serious events. So I don't think that's all that surprising. And I like to see that in terms of looking for stability, but it isn't necessarily the only thing that I'm looking at. There's no question. Look at the damage in these charts. it's very difficult for stocks to rally into this kind of backdrop and with this kind of chart damage. So we can see here, as I've been saying, we've had a pullback in the VIX and VIX futures, but really this curve is not looking all that healthy. So the fear is still embedded in some of those fear gauges that are out there. We saw TLT vol absolutely explode last week. And so there's the big concern is still, even though we have that bond put, the big concern is really, are we going to continue to see things break and fray at the very least? And that's going to be a tough thing for markets to handle. So okay, so here we can see NVIDIA here basically giving up on that news that they're basically going to be restricted from selling certain technology to China. I think that makes sense, but again, that's not good, right? Every time these things bounce back, I've been saying in a number of shows, I've been saying, don't keep running into NVIDIA and AMD and all these other things. It's not working. The news flow is not going in the right direction, despite the idea that valuations are low. Yes, perhaps if you're really sort of a long-term investor, then some of these things are going to be okay. But in the meantime, I just think there's kind of a different sort of storyline playing out right now, and it isn't in these things doing particularly well. So one of the things I've been doing, and I've been telling everyone, listen, and I've been doing this in my own accounts across different kids' accounts, collaring everywhere, protective structures, right? One of the difficult things now is that protection is very, very expensive. We've got a VIX 31.3. That is very, very expensive compared to any kind of historical measure of, the mean is probably around 19.5, and it does spend a lot of time down in the low teens. So this is extremely expensive. It's pricing in about 2% of daily movement per day. You're paying a lot for protection. Now, that cost of protection does come down because we're backwardated, right? We're inverted, meaning all the front protection, all those early weeks and months are very, very expensive, and then they get a little bit cheaper over time. But still, the whole curve has been shifted upwards. So there's no question it's expensive across the board. And we have seen in the last few months that longer term options have actually been pushed up quite a bit. And I mentioned that in one of my videos. I said, listen, this is a sign of more durable worry and fear. This is, when people push up the front part of option curves, they basically are nervous about the here and now, and they figure that at some point things are going to calm down. And while they do figure that in this instance as well, they're pricing longer term option pricing at higher levels now. So that to me is a sense that there's a more durable nature to what's going on out there. There's some big issues, whether it's a new regime from people aren't investing in the US as much, or in fact their money is flying out of the US. We have a new political regime. We have a very different scenario of being very supportive and stimulating assets. That's just not happening anymore. So there's maybe that's playing into some of these longer term prices that we're seeing in volatility, which are saying, listen, we're going to be volatile for a little while. Now, there's no question we could get into periods of where we say, hey, things are back on again and we get a low VIX. But overall, the picture is getting quite murky across the economy. What are analysts even going to come up with? What are CEOs going to say this earnings season? What can they really say? They have no clue really where things are going. So we need a lot more clarity on what's going on out there. So one of the trades I did, I have a Leaps kind of a long-term options portfolio. And I think that's a great way to basically put about a third of your money to work, get the similar kind of exposure to owning the underlying. But if you do it smartly, you can create that upside for a lot less and still have a whole bunch of cash sitting on the sideline. So a strategy that I really, really like, but I have taken a look at it, and the idea is that we hedge it, right? So I've been hedging it. I've taken off 2 hedges so far in the last, say, 6 weeks for decent money. And so these hedges are playing out as markets gyrate, and we're sort of dampening the downside with these positions. Now, some of the positions we're up a lot on, like a Netflix, and some not as much, some areas that have been more challenged, Goldman Sachs, for example. But these are generally names that I really, really like longer term. The current backdrop is difficult for some of them, but there's no question that I think these are things that I want to hold on to, and so in the meantime, I'd like to hedge. And so this time, because the VIX hedges have worked out, but I'd like something a little bit with a little bit better visibility. So I like things that sort of give me an exact, sort of precise level of protection. And you can think of the VIX versus downside protection in the SPY as that, very much that thing, right? VIX is sentiment. It plays a mean reverting thing, which is sentiment going up and down. If it gets too high, it comes down. If it gets too low, it comes up eventually. But it isn't so much tied to a particular level of on the S&P, for example, or on the QQQ. So when you play VIX, you're playing something a little bit different. It's certainly correlated to downside moves in markets, but it's a little bit different. Whereas if you own a 5,000 put on the S&P, you know exactly where your protection kicks in. There's no two ways about it. You know exactly the levels where you're starting to get that protective value. So this time I'm looking into, I looked into a September, and I won't get into the reasons why I picked September, but there are very good reasons for that, and the way that I create the structure and then manage it over time. There's a very specific way you want to do that. It's very data driven as to what kinds of structures work over time in terms of these callers, put callers, things like that. So I went out there and sold the 580 calls and used that to finance some downside. Picked up the 515s, and then I think I sold the 410, somewhere around there. A little bit of a debit, but that's a way that you can really create a nice downside profile. So I've structured it so that basically I've got something. What you need to do with something like this, when you don't have a perfectly fungible asset, meaning if I'm using the SPY to hedge 10 other positions that are in different stocks, you don't get a perfect sort of fungibility, right? Because you're using SPY to protect something that is not the SPY. It is certainly connected to the market, but is not exactly the SPY. So, but I like to do that. What you can do is you can beta weight the portfolios. You can say, well, my portfolio typically, and I'd say typically, right? Not how it's acted since Liberation Day or in big sell-offs, because things tend to correlate to one. They get very, very correlated on the downside, as I mentioned earlier. But under normal circumstances, kind of how do they act? Are they a 90 beta to the market? Are they a 110 beta to the market? Are they more reactive to a downside move than your typical market, right? And so if it's technology, maybe focused, certainly lately, you're going to get a little bit more reactivity from those stocks to a downside move, right? That the lows, the NASDAQ was down, whatever it was, 15%, and the S&P was down 10%. So there's a lot more beta to the NASDAQ right now. There typically is over time, but certainly these days as people move out of those sort of big cap stocks. In fact, we've seen some of I think we've seen the widest gap between NASDAQ, QQQ volatility, option pricing, and the rest of the market that we've ever seen, or certainly in a couple of decades or something like that. So they're really, really priced for continued downside. So on the one hand, that's interesting. There's very, very steep skew in things like Microsoft and NVIDIA, et cetera, Meta. That's an interesting, that brings up some other interesting possibilities to play the upside. But in this case, we have very, very expensive volatility all around. So you have to kind of beta weight that portfolio. What does it look like? Is it like a 0.9? Is it a 1, 110? Figure that out and then apply the appropriate exposure, right? So I have exposure in this particular portfolio that I'm saying is about 400 shares of SPY. That's basically kind of what it looks like. So I have to sort of make a good educated guess as to how that is going to act. And so with that, I've gone in and I've sold the 580 call, as I mentioned, and I'm buying the 515 420 put spread in September. And this is basically how this is going to look, right? So we have basically this ability to protect ourselves fully below 510. Now there is a slight cost to this, which is we're a little higher on the SPY, but there's a slight cost to this because there's almost, you can almost think of it as a deductible. So the protection, like the JPM collar, doesn't kick in. That's basically what we're doing here. We're kind of creating a JPM collar structure in our portfolios. And so we can see that at a certain point, we are fully protected, but we're short that lower put. So below that, we have full downside. But I'm betting that probably things don't get worse than SPY 420. At least I certainly hope they don't. That would be another 20% down from here. So that would be starting to get very, very ugly. If that starts to happen, then I'll be doing other things that continue to mitigate some of that downside. Now, to the upside, what you have to agree to is really giving up that full upside beyond 580, right? So basically, it ends up being around 576 because of the $4 cost of this structure. It costs you an extra $4 to buy this downside than you are receiving for the call. So you're getting this sort of structure that I like. I don't mind spending a little money on it. What some people do is they look for a costless version of this. So they will only sell the call that covers the exact cost of the downside put spread. And that's fine, whichever way you want to do it. I want to give myself just a little bit more upside. There is always the potential for some sort of deal to suddenly happen, and this market could really take off. I don't know if it'll be durable, but it will certainly take off and probably push up for a little while as people reassess. So this is kind of one of the things that I'm doing in various portfolios. Hopefully you guys learned something, and if you have any questions, definitely ask down in the comments. Happy to check those out when they come in. You guys have a great day. Stay safe.